share my my window. Let me just do this. It is my Microsoft PowerPoint. There we go. Opens.
Thank you, Mark. Mark Morris, for those of you who don't know him, is our in-house counsel for the offices. So if I can't answer the question, then I go to Mark. Once you go to the broker on call and it gets filtered down and I can't get it, I call Mark. And he's
I'm having
fabulous.
some trouble. Hold on a second. I'm saying, there we go. Can you see it? Let me see.
Can this like be sent out?
Can you see my window or not?
No.
Yeah.
Not yet.
No, we don't see your screen.
You have to see a screen sharing on.
Carlos,
Let me one more time. Sorry, guys. Just one more second.
How do I get like to watch it here?
Select PowerPoint. There we go. Allow.
So there might be, you might need to click on Google Meet, you click on the screen and then click start.
We just moved to Google, that's what.
Okay, just give me one second, guys. I'm really sorry about this.
Oh, we're sorry. It's we changed from Zoom just this week, so it's new to everybody.
What it's saying that I need to allow permission. So just give me 1 second.
Oh, it's
I have to figure out my security.
You're
Security.
using a Mac, Mark, you just have to click on open setting
Okay.
and then it should be, there's a Google tab or Google Chrome, you have to put the check on that.
I will have this ready for you guys. Just give me 1 second.
Open system settings, and then you should see Google on the top right corner, and then you put a check on it and put the lock back on. And that should allow you to share your screen.
Settings. Privacy. Affirms location, camera settings.
If not, if it's in a Google Chrome, where are your slides? Is it a Google Suite, or you can send it to us and we'll have it shared from our end.
All right, you know what? I'm going to do that just because that will make this easier, and it's already been enough of everyone else's time. So I'm sorry about that. Let me get this right over to you right now.
Somebody didn't send it to me.
Mark, I just want you to know this isn't your error, it's our error. We have just gone to Google out of Zoom, so.
Well, I mean, I should be able to use basic technology here, though. Hold on a second.
Hey,
There
we
we
need a
go.
lawyer, not a technical person.
All right, here we are. And with everyone's permission, I may just go 10 minutes late just so I can give you guys the proper here. I've just sent it back to KWMC 777. If you pull it up, I'll get started.
Waiting for it, and we'll pull up. Joby, I'll send it to you and share a screen, please.
No problem.
All right. All right.
Okay.
Send it over.
So let me get started. There's no time like the present, even if the present is 10 minutes after we were supposed to start. Let's get going. So thank you very much. I know we were supposed to do introductions and everything else. It's very nice to meet you guys. I know most of you, I guess, individually, but we're going to move on and we're going to get this done. So I've been asked to speak about taxes and restrictions on foreign buyers and sellers. And I know that when I was asked to speak about this, what you guys were interested in was the NRST and the prohibition on Canadians from purchasing those two taxes, but there are other taxes. So I'm going to give a sort of comprehensive overview as to how and what you as an agent need to look out for when you are dealing with restrictions on foreign buyers and sellers, and we can move forward on that basis. By the way, I'm just noticing, unlike my Zoom that has my nice background, you have my actual background. So there you go. We're going to have to deal with that reality here. All right. So at some point, this will come on the screen, but I'm going to start into this just because I want to get cracking. So the first thing that I'm going to talk about is the PPRP. So the prohibition on the purchase of residential property by non-Canadians, which is, I think, what it is that you guys are most interested in, because that's the newest legislation. And that's, of course, what's causing most consternation in our industry as we try to figure our way through this. Now, in order to really kind of go through this, you have to break it out into a single sentence. And that single sentence needs to be parsed by me to actually give some understanding of what's going on here. And the sentence is that the prohibition, and it would be on your screen at some point whenever it comes up. Oh, there we go. So if we could just turn to page 2 of that. Perfect. Okay. That was my little joke at the beginning too. Okay, there we are. So there we go. So the prohibition on the purchase of residential property by non-Canadians comes into force on January 1st, 2023. The act prohibits non-Canadians from purchasing residential property for a period of 2 years with some exceptions. And you'll note I've helpfully footnoted that particular statement, 1, 2, 3, and 4. Because if we can go through points 1, 2, 3, and 4, we'll have a comprehensive understanding of what the obligations are under law. First, what is it that constitutes a non-Canadian? A non-Canadian is, as this PowerPoint helpfully shows, an individual who's not a Canadian citizen and not a person registered as an Indian under the Indian Act and not a person identified as a permanent resident. So to be clear, and there is some discrepancy, and this is actually causes a great deal of problem for people. It is often the case that, similar to the definition of spouse, which is a whole separate issue, like common law versus married, and there's always a confusion on that point, there is also a confusion as to whether someone is a Canadian citizen, because from a realtor's perspective, as we're going to discuss today, there are 2 different types of citizens. First is a citizen that holds a passport. Second is a citizen that is a citizen for tax purposes. That is to say, sojourns in Canada, which is a legal way of saying spends over 183 days and thus files taxes. For the purposes of the PPRP, all we care about is whether you're a citizen with a passport. Doesn't matter if you've been living in Dubai for 10 years. Doesn't matter if you file Canadian taxes. If you have a passport or if you are a permanent resident, regardless of whether you're a citizen for tax purposes, that is all we care about. It's also a corporation that's incorporated otherwise than under the laws of Canada or a province. So very simply, if you're a US corporation, then you are out. You have to be registered in Ontario or Canada. Or it is a corporation registered in Ontario or in Canada, in any jurisdiction in Canada, it doesn't matter, whose shares are controlled by non-Canadians, meaning that they have over 3% of the voting rights. Now, that doesn't happen very often for you. I haven't been approached once by that. But just so you know, it's either a Canadian corporation, but even if it is a corporation, it has to be controlled by Canadians. You can't get around the law by having a US person incorporate a Canadian company and buy property, because they themselves will have a controlling interest in the company and thus would in fact run afoul of the law. So that's the definition of a Canadian, plain and simple. Well, not plain and simple, because we still have point 2, point 3, and point 4 of this deck to go through, but so far, plain and simple. So if we can move on to the next page, if you don't mind. And I'm very grateful to whoever it is that's controlling the PowerPoint. Thank you very much. All right. So let's talk, if you do not mind, about a purchase. Because again, let's go back to our sentence. The Act prohibits non-Canadians from purchasing residential property. Okay, so what's a purchase? A purchase is defined up one page. You can't get to my cool maps yet until we're done with. No, up there we go. Okay. So a purchase is defined as having a legal or an equitable interest or real right in residential property. Let me stop for a minute. I'm going to explain what an equitable right is. Many of you are aware that sometimes someone comes to you and says, hey, the price of Toronto property is just insane. It's out the wazoo. So I need to add my parents to property. And then at the lawyer's office, what we do is we do what's called a bare trust agreement, where the parents are basically saying, yes, it's my name on property. I am the legal owner of, say, 1% of the property. But, and this is a crucial point, I'm holding it beneficially for my kids. This is acceptable, by the way, for tax purposes. It means that the parents aren't going to pay capital gains when they sell the home, which is a good thing because it's usually the kids that actually, this is their principal residence, and thus 100% is exempt. I'm bringing this up as an example because you cannot get around this law by having your aunt or your uncle or your brother or your father or anyone actually put this property in their name for your benefit. That runs afoul. That's why they are saying if you have a legal or an equitable interest, then that is the definition of residential, of purchasing. So let's keep on going. So it is a purchase is not a right resulting from death or divorce or separation or gift. Now, I know what you're thinking. What you're immediately about to think of is gift. That's an interesting one. I think that's an interesting one, too. That's something that is such a big loophole that you can kind of drive a truck through it. So what you're telling me is that my father can go ahead and buy a property and then gift it to me. Technically, under the definition, that seems to be the case. I'm sure that they'll tighten it up as they go. I don't understand how it is that this was removed. And there are tax considerations when you do that, but it does seem that that is an allowance. It also doesn't include a rental transaction. So a purchase is not a rental. I know you guys understand that, but an American can come and absolutely rent property. There's no issue. It doesn't involve the transfer of a trust. Oftentimes, and I know some of you haven't dealt with this yet, but oftentimes people I've purchased property in trust for my junior children through a family trust. And when they become of age, I'm planning on transferring this on over to them. And as a result, if the trust was established before this law, you can get around it. That's that you're never going to encounter that as a realtor. Or if the transfer results from the exercise of a security. So technically, smart people will eventually figure out if this prohibition stays in place for more than 2 years. P.S. It won't. We'll talk about that shortly. That's my personal editorial take, but we'll talk about it in a minute. But if there's a power of sale or something else, then you're good. So technically, you can have dad buy the property, put a mortgage on in favor of a non-resident, and then have the non-resident exercise a power of sale, and then you're incongruent with the agreement. Yeah. All right, let's keep moving. And yes, everyone seems to be very anxious to go over to this map page. So let's talk about the map page. So we're now on point 3, because remember, we've now talked about it prohibiting Canadians from purchasing. We know what that is. We know what a Canadian is, but we don't yet know what residential property is. So let's address that. What's a residential property, you ask? I know you would ask, but most of you are on mute. But each of you would individually ask me that, and as a result, I'm going to answer. So what's a residential property? A residential property is a detached house or similar building containing not less than 3 units. You'll note that this is different than the NRST definition, which we'll talk about, which has 6 units or less. There's an incongruency because this is a federal piece of legislation. And this federal piece of legislation defines, by the way, common law spouse differently. You know, Ontario's definition of common law spouse is 3 years, living together for 3 years or having a child together. Well, this federal piece of legislation, which has to deal with all jurisdictions in Canada, defines a common law spouse as only 1 year. Interesting. Similarly, in the same way that the NRST says a residential complex is 6 units or less, this piece of legislation says a residential complex is less than 3 dwelling units. In other words, if you have an American client who's looking for a multi-res property with 100 doors, you're cool. This doesn't run afoul. That's not a residential property under the definition. It's part of a building that's a semi-detached house, a row house, a residential condominium, pretty much anywhere where someone is living. We could go through that, but that seems pretty obvious. It's not a farm. It's not vacant land. It's not commercial property. Anyone who has a client who's looking to buy the Eden Center, by the way, the value of that is significantly down now that Nordstrom's left, but anyone who wants to do that, go ahead. You could do that. It is not a residential property, as anyone who has a head on their shoulders can attest. And it's land that doesn't contain any habitable dwelling and is zoned for residential use or mixed use. Within, and this is the critical component, a census metropolitan area. So the government decided to bring in a term that very few people had ever heard of before. Now, you did if you were attuned to Statistics Canada's DAs and aggregated studies and everything else. That's great. but that's never been part of our legal lexicon before. And so everyone was kind of hopping around going, what the heck is a CMA? What is this thing that they're defining? And so rather than define what a CMA is, here's a list of all of them. Like, here it is. It's in my presentation. It can be sent to you. This is literally a list of every single jurisdiction in Ontario that falls within the PPRP. And what this means is if you are working in Booneyville, Ontario, not anything close to residential, if you're dealing with like a home in some county somewhere, you may very well be fine. You may not fall afoul. So you can account for this by the list on the left-hand side of the screen, which again will be sent to you. Please feel free to circulate this PDF afterwards. But it has to be within one of these areas in order to fall afoul of the PPRP. Does that make sense?
Yeah.
Okay. So far, so good. We're going to move on to the next page, even though that had the colorful mouse. All right. We're on point 4, guys. Point 4. Some exceptions. Actually, I'm going to pause for a second before point 4, and I'm going to focus on something that doesn't have a footnote. You see, for a period of 2 years, I want to just talk about that, and this is purely editorial. One of the reasons people hate government so much is because it's so behind the 8 ball. You know, we all, particularly all of us as realtors, we all see fraud taking place well before before it becomes endemic to the point where legislation has to be put in place. We all see mortgage abuse well before ultimately the government takes action. And that's because we're on the ground, and it takes the government a long time. They have to be punched in the nose many, many, many times before they start saying, hey, how do we swat this fly? And of course, the same is true of foreign ownership. I must say I was part of this. I was in China many, many, many times facilitating money transfers from Shanghai and other places, bringing it into Canada. Maybe I shouldn't admit that in a recorded video, but there it is. And many of us partook in that money flow for a long, long, long period of time, and we all understood that it was taking place. And the government finally got up and said, wow, this is becoming a substantive action. And they did so in January of 2023 when the market had plummeted and when fundamentally the very problem that they were looking to address kind of left, because most of the people who are bringing this money in are foreign investors, and foreign investors are there for a return. And if you're going to only plateau or go sideways in real estate value, which is what the expectation is in the coming years, then you don't really need legislation to stop the money flow. Money flow will not come in if there is no excessive return. So will this exist beyond 2 years, particularly if there's a change of government or anything else? It's doubtful. It's honestly doubtful, because I'm not sure what role this legislation is playing anymore. But at the same time, while we're editorializing, let me just tell you one quick thing and a quick story, which is very interesting. I went to the Shanghai Property Show. I was there for like 3 days peddling products and being a lawyer and doing whatever else. And the Shanghai Property Show was very, very interesting. I went just before the Chinese government made a choice of actually cutting off the North American currency basket, which stopped government officials from flowing money into Canada. This is all behind the scenes, but this is what happened. And it happened, and I was there, I think, in 2017. And in 2017, you walk around the Shanghai Property Show, and what's fascinating was there were more Canadian booths than anything else out there. More than Australian, more than New Zealand, more than the United States, you name it. Canada was there in force. And when I went over to particularly New Zealand and Australia, I said, well, what the heck? Why do you guys only have 1 or 2 of these things? They said, well, we just brought in foreign property restrictions. I said, you can't get around them? They said, oh, no, there's a million ways of getting around them, but the government is actively discouraging it, and the Chinese investors just don't want anything to do with this anymore. It has had its effect. It has slowed down investment. And so just as an aside, merely having this legislation actually works, even though there's ways around it, even though the gift, even though the secured interest, whatever it is. By stopping this, by making it harder, the government is actually stopping foreign investment flows. And I saw that firsthand when I was at the Shanghai Property Show. Okay, enough editorializing. Let's move back to the law. Let's move back to with some exceptions. So we understand what non-Canadian is. We understand what purchasing is. We understand what residential property is. Now let's go with some exceptions. So what are the exceptions? So the first is international students. Now the international student exception is so riddled with qualification as to be totally freaking meaningless. as far as I'm concerned. I don't think I'm ever going to see someone qualify for this. Why? Well, because you have to be enrolled in a program. Okay, fine. That's easy. You have to have filed taxation for the past 5 taxation years. Now, if any of you know international students, they're coming for 4-year degrees. So already we're only allowing people who are getting MAs or PhDs to qualify for this to begin with. Plus, who the frig as an international student even files taxes? Like, you're making no money. Half of them aren't filing taxes. They aren't thinking about what's going to happen 5 years out. Good luck to you finding someone who can qualify. But assuming you can, assuming you find that PhD student who's been working 13 years towards the degree and has been filing taxes and everything else, then they have to have been in Canada for a minimum of 244 days. Okay, that's fine. We have enough days of summer that people probably are doing that. We're good. And the purchase price of the property can't exceed $500,000. Well, good luck to you now in Toronto, and good luck to you in Mississauga, and good luck to you in Vaughan, and good luck to you in all the places where we have our educational facilities, right? Like even Guelph and Waterloo, and like, okay, we're taxation and $500,000 minimum, and you can't have purchased a residential property in the past. So honestly, this was done by committee and was probably done to satisfy maybe London, Ontario. I guess we can have something in London, Ontario, but you know, like, and Kingston, I guess, and Queens. Students from Queens doing their MA and PhD will love this particular provision. But really, guys, like, we're not going to see this being used very much, because to qualify for this is just egregiously difficult. It's different if you're a work permit holder, particularly because the $500,000 limit is removed, right? With a $500,000 limit, you're good. You're good, and there are still arduous requirements. So you have to have worked on a full-time basis for a period of 3 years within the past 4 years. So that's one. You have to have filed your income taxes for 3 of the past 4 taxation years. Again, that's not really all that difficult, because if you are in fact on a foreign work permit, you absolutely are going to be trying to go for PR. And part of filing your taxes means that you're actually qualifying properly. So realistically, you're not going to find that the people who are on these types of permits are not filing their taxes. And as long as they've been here really for the past 4 years, they should have 3 years worth of records. And there is not a $500,000 restriction. And usually they haven't purchased a residential property. So the work permit holders is an actual real exception, as opposed to the ridiculousness of the student visa, which is never going to be used. Now, understand, this is a federal piece of legislation. It's different than the NRST rules, which we'll talk about. You still may have to be subject to the NRST rules, even if you are exempt under these rules. I just had a case like that recently. We'll talk about that in a second. And then, of course, you have spouses or of qualified or exempt persons. So if you fall within any of these categories, if you are a spouse, defined as being common law with someone for 1 year. Common law is not just roommates. It's roommates that make you smile. So common law, or common law spouse, or married, then in fact, you can qualify as long as you're their spouse and you're ready to attest to that. And then there's a whole bunch of other exemptions that I don't want to touch on. You can write me and say, Mark, is this exempt? I hear it may be. So we have diplomatic passports, refugee claims, yada, yada, yada. Okay. So those are the exemptions. Okay, let's talk about the next page. The penalty for non-compliance. This is, again, a total joke, but is there because it puts some law in place. So let's read what the penalty is if we disregard. I'm talking about we as a purchaser. A purchaser that knowingly disregards the PPRP is subject to a massive fine of $10,000 on their $2 million home. And technically, the courts have the authority, if they want, to reverse the purchase, which is more substantive but would never actually happen. Practically, it would just be $10,000. That's what's going to happen. Of more interest to me, of more interest to you, is, of course, your professional obligations. Because whilst the penalty for purchasers aren't going to be that great, you have a duty to abide and conduct yourself in accordance with legal standards. And it is extreme negligence, if not abetting fraud, to knowingly help someone break or violate this law, even if the penalties are slight for your purchaser. Remember, and I often have this discussion with agents, there is nothing wrong with breaching a contract. It's perfectly legal, often doable. Don't do it without a lawyer, but not a problem with it. If I say to you, hey, I'm going to go to the store, I promise you give me $5 and I'll buy milk for you, and then I don't do it, there's nothing illegal about that action. It's just a contract between you and I. I have canceled the contract. I just haven't acted in accordance with the contract. Don't get me wrong, there's ramifications. I can be sued. You can claim your $5 back. You can claim damages. All of that is true. There are ramifications, but there's nothing illegal about it. There is, however, something illegal about knowingly violating a statute, which is what is going on here. So this is a much greater consequence. No agent who is attending today's session should ever be knowingly abetting or assisting someone in helping them create a fraudulent circumstance. And this goes beyond this legislation. It's also from the Mortgage Brokers Act or anything else. Do not abet fraud, clearly. And so we as professionals, even though the tap on the wrist to the purchaser is slight, from our perspective, this is something which we need to readily abide by, for sure. Okay, let's move on. Does anyone have any questions so far before I go? No, we're good. Okay, I can't really see if there's chats or anything. Okay, let's move on. So we are moving on to the NRST. Is it okay if I go into the NRST? Because I really want to go over all of the ramifications. I want people to understand the full body. When you are presented with something, it's not that you only need to think of the PPRP. You have to sit there and say, you're a foreign resident, what laws are applicable? And there are several, so I want to go over each of them. So with your permission, I'm going to go over the NRST now. So the NRST is a 25% tax premium that is levied on a purchased property if someone is a non-resident. Sorry, Deb, you wrote something, permanent residence, or okay, I don't think that was to me. So if there is a property that has less than 6 residential units.
Sorry, Mark, Tanya had asked, what about permanent residents?
For what? For NRST or for PPRP?
I think she's still talking about PPRP. Were you, Tanya? Maybe she can't.
Sorry about that.
Yeah,
Just give me 1 second.
I did, but Mark covered that. So yeah, so I think I'm clear now. Thanks.
Mark, are you also
Can
going
you
to?
give me one second, please? I'm sorry. My office is street side and my dog started barking wildly because the mail time came. So I apologize for that. Sorry, what was the question, Tanya?
She said that you answered it, but I was going to ask, are you also going to talk about the foreign buyer tax? And just, I know, juggling between the prohibition and the tax in terms of when people apply for their permanent residency, when they get it, and if they get the foreign buyer tax back, that kind of thing?
I am. And let's recall, Deb, that tax is a tax that comes about from a different piece of legislation called the NRST tax, which is what I'm actually touching on now. So the PPRP is totally separate. The PPRP is just a prohibition. You cannot buy. This is you can buy, but here are the provincial restrictions. That's why I wanted to touch on
My apologies. I was mixing the non-resident tax with the vacant property tax.
No problem. So
Non-resident-
let's go on, and then I'm going to talk about the tax on sales. So we'll be clear by the end, I promise. So the NRST is a tax of 25% that is payable when a non-resident of Canada buys a property, so long as it contains less than 6 units. Let's go through what this law is. Now, by the way, if a non-resident owns even a smidgen, even a 0.1% of the property, tax is payable on the full amount. So you can't get around it by just putting 1% or anything else. It's on 100% of the consideration value if even a single non-resident owns a qualifying property. So with your permission, let's start delving into what the NRST has to say. So the NRST starts off and it says, everyone is subject, next page, please. Everyone is subject to the NRST except for Canadian citizens or permanent residents. We're going to start there. Now, again, definition of Canadian citizens or permanent residents in this instance is the same as the PPRP. You have a passport or you are a permanent resident. Doesn't matter if you've been in Dubai for 10 years. You are exempt if you have a passport. In other words, if you have a passport of Canada, regardless of where you are able to buy. There's no prohibition on your purchase, and there is no NRST payable ever. Make sense? Also, a foreign national operating under the Ontario Immigrant Nominee Program. So if someone is here on a work permit, I'm just going to leave it at this, then they can likely be exempt from the NRST. Sorry, it's not a work permit, it's a foreign national operating under. Refugees are exempt, and similar to before, spouses are exempt. Now, the problem with spouses is that spouses in this definition is different than the previous definition of spouse. I know this is complicated. The PPRP definition of spouse is 1 year of living together. The definition of spouse for the NRST is 3 years of living together. So as my clients this week just discovered, they have been living together for 2 years. They are not exempt from, they are exempt. One of them is Canadian, one of them is not. They both need to be on title because that's the way they can qualify for a mortgage. They're able to buy the property, but if they buy the property, unfortunately, one of them is still subject to the NRST, and thus 25% premium on the whole amount. Sucks. There it is. Let's move on to the next page if you don't mind. I don't really want to talk so much about that. I just want to basically say the NRST tax is separate and apart from the from the prohibition tax that we talked about at the beginning. Let's move on to the next one because it's the third tax that I want to talk about as well. And then we'll have discussed all 3 taxes that affect foreign ownership. And the third tax is not a new tax. It's been around forever. It's called the withholding tax. Now, this is a tax that is becoming increasingly important in today's world of declining or stable real estate values. The withholding tax is a tax that is paid on every sale on every sale where the owner of the property is a non-Canadian for tax purposes. Remember the first 2 pieces of legislation I've talked about. I've said if you're a Canadian citizen and you're living in Dubai for 10 years, you're fine. But this tax, the withholding tax, is payable by a seller if they do not file Canadian taxes. How do you know as an agent? Well, as an agent, you should just basically say, if someone is a non-resident, can you confirm with your accountant that you are a resident of Canada for tax purposes? And it matters. Let me explain why by going to the next page, if you do not mind. So we have a scenario where anytime someone sells taxable Canadian property, that's real estate in English, that derive more than 50% of their value from Canadian sources, that is real estate, the buyer has to pay the government 25% of the purchase price to the government. And because of that, and the reason that unless they get from the seller a statutory declaration that they are residents of Canada, so a promise that they are resident of Canada, which was done through the lawyers, or a clearance certificate from the government stating that the taxes on this deal have been paid. So let's go through a scenario that I've outlined here. Let's take a normal residential sale. So the property is originally, and this is, there's a whole bunch of like caveats that I can make, but this is just to understand the concept. A property is purchased for $100,000. The property is sold for $250,000. So what's the gain? The gain is $150,000. Okay, let's assume that there's capital gains that's payable, which is what normally happens when you sell property. So of that, so 50% of that 150,000 is $75,000. And if you include that in someone's taxable earnings, and that person has earned over $229,000 in 2022, well then they owe $40,500 of that to the government. Does that make sense? Just that's how taxes work. Okay, Deb wants me to go over this again, which I'm going to do. So we have a property that's purchased for $100,000 and the property is sold for $250,000. That's so far easy. So the gain on that is $150,000. That's how much money the government is interested in. The government doesn't care about the first $100,000 because that's totally irrelevant. You have, by owning this property, made $150,000. Now, there's all sorts of exceptions. You're allowed to deduct a whole bunch of things. You can deduct the cost of sale and everything else. I'm not getting into that. I'm just conceptually, you understand that in this scenario that I've outlined, there is a $150,000 gain. Now, of that $150,000, what happens? Well, if it's income tax, you have to take the $150,000 and pay tax on it, which at the highest tax rate in Ontario is 54%. But that's not what usually happens with real estate. Real estate is usually a capital gain, right? And so only 50% of that $150,000 is taxable. So we're going to take the $75,000 that we see here, because that's 50% of 150, and we're going to include that in the income at the highest tax bracket. And so the amount of money that we owe the government is $40,500. Does that make sense? Okay, I'm going to pause for a second. Does anyone else have any questions about that? Keeping in mind, I can't see the chat icons. No, we're good on that? Okay. Let's deal with a foreign residence tax sale. The property is purchased for $100,000. The property is sold for $250,000. Same thing, there's a $150,000 gain. The government gets 25% of the total amount of the $250,000 from the buyer or from the seller. This is the way it actually works. But the buyer is obligated if the seller doesn't pay it. That's the way it works. So the government gets 25% from the buyer or from the seller, $62,500. The tax is still the same amount of tax owing, right? Doesn't change. Sellers, foreign sellers do not owe more tax to the government. It's how they pay it. So they still owe $40,500. And so when the foreign seller files their taxes, they're going to get back from the CRA a check for $22,000, which is the difference between what they owe and the amount of money that the CRA has collected. Does that make sense? And the reason that we do this is because sellers who are not resident of Canada can take their money and disappear, and the government wants to see their money. So what they're doing is they're taking the money up front and saying, unlike Canadians that we know we can pursue, we are going to take our money up front and you will file your taxes and we'll give you back the premium. By taking 25%, we know we have enough to cover your obligation. Yes, Deb.
I think I'm understanding you, Mark, but the slide says anytime a Canadian sells taxable Canadian property. should it be anytime a non-Canadian sells?
You're correct. I'm sorry. That's a typo. Thank you for that. I'm sorry. I'm sorry about that. Thank you for that pointing that out. I didn't even realize that. Now, let's talk about why this matters from your perspective. Because frankly, many of you have been in practice for 10, 15 years and you've never even had to consider this tax. You're just like, because part of, I think it's section 17 of the standard OREA agreement deals with this. It says that the seller shall provide a statutory declaration, and if they don't, then this shall happen, what I've just described. And truly, in a market that's going up in value, it's never really much of an issue. Why? Well, because banks are extending what routinely on a deal? Usually about 80%, right? Usually, they're extending about 80%, sometimes more, but usually 80%. And if you hold on to your property for 5 years and it goes up massively in value, then even if the seller is a non-resident, there is enough money after 5 years to pay the 25% and the mortgages and allow the seller to then file the taxes, which is what happens after you guys go away and you've gotten your commission. That's what happens between me and the accountant in my office. That's what's going on back and forth. And you never see that. But let me give you the scenarios that I'm now seeing hit my office where property values have dropped. Someone has gotten a mortgage of 80%. They're a non-resident. They sell. Now there's a problem because we have commissions to pay and we still have 80% to pay off because the value of the property has declined now. Can we provide clean title as lawyers? We need to take 25% of the purchase price and remit that to the government. We need to do that. We have to provide clean title. We need to pay off the mortgage and we need to pay the agents. Do we have enough money now? The reason this hasn't been an issue for you is because you've been in a massively expanding upward market for a long time. And as a result, the market covers all problems. But if someone says to you that they're a non-resident, and if you check title, and you should always be checking title. By the way, we'll talk about how you check title because a lot of agents aren't aware of that. But if you check title and you see that the registered mortgage amounts are nearing 75%, of the actual price that you're going to be paying after you account for commission, then you should pause and you should determine for sure that they are a resident of Canada. Because if someone needs to withhold the 25%, we may not have enough money to clear title. Does that make sense? So I know it's confusing, guys. Two of the things that we've discussed, the PPRP and the NRST, are at the purchase side. And the withholding tax that we've just discussed is on the selling side. But those three taxes constitute the taxes on foreign ownership in Canada generally. The PPRP is an absolute restriction. The NRST is an additional amount payable, and the withholding tax is not an additional amount. It's simply a different mechanism of paying the tax on a sale. Does that make sense conceptually so far? Yeah? Okay, fine. So that being the case, let me see what my next page has. This is what you can do. I've talked about it. You can either pay your 25, you can withhold 25%, you can get a clearance certificate from the seller, or the seller can prepay their taxes and get a clearance certificate from the government. Speak to your lawyer if you're dealing with a non-resident, doesn't matter. But it's the next page that's the most important, actually. The one after this one. You can just turn down one more page. There you go. All right. Technically, if I was controlling, I'd have that on subtly and just have that on the background. So look, guys, we have 10 minutes left. So 10 minutes left for questions. That's how this all works together. I'm open to whatever questions you have. May I suggest you just either verbally, like I guess, Deb, is it okay if we just have people ask verbal questions? Not too many people on this.
Sure, why not?
How do we check title?
Yeah, very check title.
Oh, how do you check title? So
Yeah.
glad you asked this. Okay, this is not what I've been asked to present on, but I am going to tell you because every agent should know this. Okay. So, you know how that wonderful thing called Geo Warehouse is available to all of you, and you know how you futzed around and checked it all out, and it's so cool, and you've checked out how much all of your friends paid for their various properties and everything else. Come on, we've all done it. Well, the one thing you haven't done is you haven't actually, well, you've clicked on that purple thing that says parcel registry, right? But what you never did was pay the $32 that says, please enter your credit card here. And that's the reason you don't know what it can do. It can do wonderful things for you, GeoWarehouse, including providing you with title. The same thing that we pull. And you can put it in, you put your $32 in, and every single person who's selling a house should be pulling title to make sure that it's clean. I understand you're not lawyers, you're not supposed to read it. That will be done by the selling lawyer, but you can understand it. It's not that difficult. In fact, I give sessions on how to read title. And if you'd like, I just gave one to on the block. I'm very happy to come back here and show you how to do it. The really interesting thing, most people have, well, some people have gone ahead and paid the $32. What's really interesting is that when you take a look at a parcel registry, it has a whole bunch of line items. It says transfer, it says mortgage charge, it says notice of security interest, whatever it may be. And it lists all the things that are on title. That's kind of what a lawyer does. What's really interesting, what most agents really don't know about, is the power of GeoWarehouse. Because if you take the instrument number, so each of these line items are double clickable, okay? Like you can't double click on them technically because it comes as a PDF, but think about them as like double clickable things. And so if you have something like an easement, or if you have something like a notice of security interest and you want more information about it, and it's 9 o'clock at night and the lawyers aren't available, P.S. I'm always available, but lawyers are not available, well, then you can take your instrument number, which is on the left-hand side of the title search, and you can plug that into GeoWarehouse's search function, AT32794. And then it's going to ask you to pay $3, which you haven't paid again because you just didn't want to pay your $3, or because you didn't know that this was doable. And that will actually pull up the underlying instrument of the title search. So you guys at your fingertips, without even knowing it, have the ability to pull title. Now, let's relate that to what we're talking about here. What are you looking for? Well, when you are listing a property, particularly if someone says that they are non-resident, you want to pull title, pay the $32, and you want to see what the registered charge amounts are for. If there's to TD Bank for 60% of value, and then a secondary mortgage for 20% of value, boom, you're at 80%. Okay, red flags should be going off. Let's speak to a lawyer. Let's figure out what the actual amount is, because these are just the registered amounts. Maybe there's less that's owing. Let's look into this further. But that's what you need to do in pulling title. Does that make sense? Okay. By the way, best thing about GeoWarehouse is still checking out what your friends paid. But this is cool too. This is very cool. All right. What's next thing? Next question.
I'm just checking the chat.
This is a new one. For withholding tax, what should we be doing as realtors to communicate with our buyers and sellers before we have the sale in place?
Right. So first off, you don't need to worry about it because the standard OREA form already has your clause that you need. You know, like that third page of the agreement that everyone skims through and says, that's just standard. Let's turn our attention to Schedule A. You have to make sure that HST is included in. Well, one of those clauses that you're constantly skipping actually deals with this exactly. So no issue whatsoever. It's already accounted for. From your perspective as agents, if you are a seller, one of the questions you should be asking is, are you resident of Canada for tax purposes? And if you suspect they are not, then A, ask their accountant for proof or verification that they are a resident of Canada for tax purposes. And B, or alert the lawyer for the seller, but B, do your title search and make sure that the registered charges after commissions still leaves room for 25% to go to the government in a worst case scenario. The $32 title search does not tell you if they're Canadian, Deb. Remember, for the purposes of withholding tax, which is why you'd be doing a title search, Canadian is someone who is it doesn't have to do with citizenship. It has to do with whether or not you're filing taxes to the government, and only their accountant would be able to determine that. Only them or their accountant. This isn't the job of a realtor. It's not the job of a lawyer. It's a job where you say, can you please confirm with your accountant that you are a resident of Canada for tax purposes? And if they say to you, yes, I am, I'm promising you I am. Okay, you've done your due diligence, fine. At that point, in the event that they bring it to a lawyer and we later discover that they aren't, okay, I mean, listen, people can lie to you. You've done your due diligence. Does that make sense?
Yeah.
Okay.
But the buyer is going to have to know that they're going to have to pay this 25% on closing, right? The same way that they have to pay their land transfer tax on
The buyer doesn't. It's an obligation hoisted on the buyer, and that's the reason that the buyer goes ahead and makes the seller get this clearance. So what it is the seller, if they do not do what they are requested to do, the buyer is responsible. That's why the buyer's lawyer cares and makes sure that the seller either has paid this to the CRA or has gotten a compliance certificate.
So
Because if they do not, then the buyer will ultimately be responsible. There's a famous case in Oakville where an Arab sheik sold a property and a lawyer screwed up, and it was like a $32 million sale. And they said, we are not residents. And the buyer transferred all the money over to the seller, and the seller took off. And the buyer was thus responsible for 25% of the $32 million.
so
By the way, they sued their lawyer, and their lawyer had insurance for $2 million. Always go to a lawyer that has more than the mandated amount.
Mark, just to follow up on that question, so you did cover if your seller says that they are a resident, but what if they say, okay, they're a non-resident? Then what is the next step that we need to take as a realtor?
So if they're a non-resident, there's no issue. What you should be saying is, let's get you in touch with an accountant or a lawyer before you sell, because I know that you don't have to pay any extra tax, but you have to pay tax differently. So let's first make sure that there is at least 25% of a cushion here. That's what we need to determine before we go firm on a deal. And let's make sure you understand what your obligations are, because you're going to have to file your taxes quickly in order to get back your money.
And then that, okay, so the 25%, is that held back by the lawyer? Like how?
The way it works is the lawyer holds it for 60 days in their trust account. Then by law, they turn over the full 25% to the CRA. And then the seller can go ahead and file their taxes at any time. The CRA doesn't care. They're sitting on more money than they need. They can file their taxes at any time and get the balance back.
And as a listing agent, what do you need to disclose to buyers on property?
Not a thing. This is not relevant to the buyers. All you need to make sure of, because it's between the seller and the CRA. The only time it becomes relevant to the buyers is if the seller can't close. And what I'm telling you to do is determine that the seller can close by ensuring that there's at least 75% of the purchase price that's being paid will cover the existing charges. And as long as you've done that, the buyer doesn't care. The lawyers will take care of things. The only time this can become screwed up for you is if you sell a property where the debts and obligations, including the realtor's commissions and the existing charges on title, are in excess of 75%, because 25% has to be remitted to the unit. Does that make sense?
Yeah. Mark, I did have another question about that. If they have been residents for a while and are now non-residents for tax purposes, how does that factor into?
Same thing. You can become a non-resident. It depends in the year that you are selling. If you are a non-resident in the year you are selling, even if you've been a resident for the past 19 years of your ownership, if in the year that you're selling you are a non-resident, then the non-resident tax is payable. Remember, you're not going to be paying any additional tax. You're not, as a non-resident, paying more tax. You're just paying it differently. Because if they were resident, they'd still have to pay that $40,000. They would just pay it a tax.
Got it. Okay, thanks.
No problem. Anything else?
Yeah,
Don.
hi, Mark.
Hi, Don.
Mark. I have a question about an American-Canadian dual citizen who may not necessarily actually hold a Canadian passport because they haven't applied for one. They've been living in the U.S. for in excess of 10 years. Their parent had passed away and they came back to Canada and acted as a power of attorney to sell the parent's property. Is there any issues around that?
None whatsoever. They can act as a power of attorney. That's not an issue. If their parents passed away, first of all, they're not acting under a power of attorney. They're acting as under an executor, under a will. Remember, a power of attorney ceases to have force and effect after death. But if they're acting as an executor under a will, there's no issue. They're selling on behalf of the estate, not themselves. Now, there will be a host of other issues if they're a non-resident and they are acting as an executor. I don't want to get into that. That's a separate thing. There's bonds that have to be created and everything else. It's way easier to have a Canadian be an executor. But once they already are an executor, there's no issue. They can easily sell the property and there's no problem whatsoever. There's no withholding tax by being an executor seller.
All right, thank you.
No problem.
Any other
Anything
questions? I think not. Thanks, Mark. Thank you so much.
No problem. I must apologize, by the way, just because everyone has been very, very gracious in saying that you guys had technical snafus. But the truth is, I looked through my email records and I had agreed to come downtown. And so I do apologize for that. That was on me. Having said that, you saw the semi-dying plant that I currently have. No one sees with my Zoom background. So think about it as a treat.
Thank you, Mark.
All right, guys. My best. Thank you. And please feel free to circulate the presentation. Anyone has any individual questions, please feel free to give me a call, okay?
Thank you.
Thank you.
Thank you so much, Mark.
Okay,
That was
thank
great.
you, Mark.
My best, guys. Take care.
Yeah, tax, you know, the STW.